Morning. My name is Susanne Mariga, and I am the managing member of Mariga CPA. And at Mariga CPA, we specialize in outsourced accounting, taxation, as well as profits first coaching, and we specialize in the healthcare staffing industry. And today we're going to talk about one of the topics that really comes up a lot in my business, and that is related to entity formation and what type of entity makes sense for your business. And I'm going to be honest with you, I get this question a lot, especially when there's a new business or a new client. They're always looking for, a lot of times, legal liability protection. But I'm going to be honest with you, one of the best ways that you can protect yourself from legal liability is to have adequate insurance in place to really mitigate your risk. And in addition to insurance, have good practices, policies and procedures and controls in place to mitigate that risk too, to prevent behavior or how to deal with situations where that risk would go up for that liability for you to mitigate that from the get-go. And really, there are four types of major legal entities, and I am going to talk about those. There are more, but today we're going to focus on these top four. And those four entities are: one, your sole proprietorship; the other is your partnerships; the other is your corporation; and the final one is the limited liability company. So let's start with the sole proprietorship. The sole proprietorship is the simplest business entity that you can form. I always consider it kind of like my daughter's lemonade stand. You literally hang up your shingle and you start doing business. Some states will require, or counties will require, that you register the DBA with the county. But for the most part, it's the simplest formation of any type of business entity. You literally just decide you're going to be in business and you start selling. Now, the taxes are super easy, and the sole proprietorship you file actually as part of your 1040. There's a Schedule C that you file it on. But the con of it is there is no legal liability protection when you have a sole proprietorship. You literally have all the risks, but you also have all the rewards. And all the earnings that you earn in a sole proprietorship are subject to not only federal taxation, but 100% is subject to your Social Security and Medicare taxes also. Now, the other entity is the partnership, and the partnership is very similar to a sole proprietorship. Again, it's very simple, except that you have two or more owners in a partnership. You are going to file a separate tax return, a 1065, which is a little bit more complex than a sole proprietorship. But again, the registration with the state is typically not required, maybe from a DBA standpoint, but again, very simple to do. But the con again of the partnership is that it's also, there's no legal liability protection. As a partner, you have all the rewards, but you also have all the risks, and your personal assets are at stake. And those earnings are again subject to federal taxation and in addition to Social Security and Medicare. The third type is the corporation. And a corporation, it gets a little bit more sophisticated than the sole proprietorship. And the corporation, you do have to register with the state, but one of the benefits is that it does offer the shareholders liability protection. And what that means is that in the event that something would happen in the corporation, the shareholders' assets are individually protected from the corporation liabilities. And I always kind of equate it to like having a child that turned 18. The day before they turn 18, when they're 17, you are responsible for that child. Anything that child does, you're responsible for it. But the day that they turn 18, guess what? They are responsible for their own actions. And that's a lot what a corporation is. It is a separate legal entity, separate from the shareholders, and it is responsible for the risk, the rewards. Now, the con of a corporation is you are subject to double taxation. So that means that the earnings of the corporation are subject to tax. And when you draw it out as a dividend, you're taxed again in the corporation. The final one that we're going to talk about today is the limited liability company. And I like the limited liability company because it offers you more flexibility. Again, you have to register with a state, but you have that liability protection that you had in a corporation. But from a taxation standpoint, you can choose to either be taxed as a sole proprietor if you're a single member LLC, or as a partnership if you're a multi-member LLC, or even a corporation. You can elect to be taxed as that if you complete a number form and elect to be taxed as a corporation. Another great thing about the limited liability company is that you have the option of also electing to be an S corporation. And you can also elect to be an S corporation as a C corporation too. But keep in mind, as an S corporation, you're really not, it's not a state designation, it's an IRS designation. And the benefit of being an S Corp is that some of the earnings are subject to Social Security and Medicare because you're required to take a reasonable salary. But anything outside of that reasonable salary, which we call our distribution, is not subject to Social Security and Medicare. So that is really one of the great things about being an S corporation. Now, you are required to file a separate return. You have to file an 1120S. But what happens is you avoid that double taxation if you choose to be taxed as an S corporation, because the taxes are passed down to the shareholders on their K1 on their 1120S. And yes, the shareholders, if they're officers in the business, they do have to take a reasonable salary, and that reasonable salary is subject to Social Security and Medicare, but that distribution is not. But there are some requirements to be an S corporation because it is a tax advantage. You have to have less than 100 shareholders. You have to have just one class of stock. All of the shareholders have to be U.S. residents or citizens. And the shareholders have to be either individuals, even though certain trusts, estates, and exempt organizations can qualify. But a shareholder cannot be a partnership, and it cannot be a corporation. Now, let's take a minute and let's talk a little bit about tax strategy. I'm going to show you an example here. So here I have a very simple example of the business entities and the tax impact of the business entities. Now, keep in mind, this is a very simple example. It's not going to include some of the credits or self-employment deductions or deductions that may be out there that may normally be included in a full tax return. But for simplicity, I think this example will get the point across of the tax impact of the different business entities. So here I have an example of a person that makes $100,000 in their business. And they are the sole breadwinner in their family. And so they are under the 22% married filing jointly tax bracket. And their FICA and Medicare that they're going to pay taxes on is going to be about 15.3%. So in this example, my person operates as a sole proprietorship. 100% of his earnings are subject to federal taxation. And frankly, it's going to be subject to taxation, federal taxation, no matter what type of entity that he chooses to be. However, 100% of the earnings are also subject to FICA and Medicare under the sole proprietorship. So the total tax that he's going to pay as a Schedule C filer or sole proprietorship is going to be this federal taxation of $13,879 plus this $15,300 to equal total tax as a sole proprietor of $29,179. Now, keep in mind, there are some other deductions that we can get a little bit more complicated, but for simplicity reasons, I want to keep it at $29,179. Now, if he chose to be an S Corp, because he's an LLC or C Corp that is going to be electing to be an S Corp, he's still going to pay the same federal taxes. So what he would have paid in federal taxes as a sole proprietorship, he's going to pay that on an S Corp, because as an S Corp, he is a flow-through entity, and he's going to be taxed on his 1040 on his K1. Now, what he's going to do is he's going to take that same $100,000, but he's going to say, hey, I have a reasonable salary. And my reasonable salary is $70,000. This is what I would make if I was working at another company that had similar earnings doing a similar position. I would make about $70,000. And the $70,000, which is a regular wage, is subject to the employment taxes. So it's going to be subject to this Social Security and Medicare of $10,710. Now, when I take my $100,000 total less my reasonable salary, I have $30,000 left, which I'm going to take as a distribution. And my distribution is not going to be subject to Social Security and Medicare, which is the benefit of being a S Corp. So my total tax is going to be this $13,879 plus my Social Security and Medicare that I paid on my reasonable salary of $10,710 for a total tax of $24,589. So you can see the difference between me being taxed as a sole proprietor versus me being taxed as an S Corp. There's about a $5,000 difference. So some pretty significant differences just because of the type of legal entity that I'm choosing to be, and also the IRS status that I'm electing to be. Now, let's say that my taxpayer decides that, hey, I'm going to be a C Corp. And it could be for various reasons. It could be that he plans to grow beyond 100 shareholders. He might not be a U.S. citizen or a U.S. resident. And so a C Corp fits his needs. Now, if he's a C Corp, he's subject to federal taxation, but his tax rate's a little bit different because now he's subject to a flat tax of 21%. Because under the Tax Cuts Job Acts, we now have a flat corporate rate. Now, in addition to this federal taxation, he's going to draw this money out of his company. And so he's now going to have to take a dividend. and that dividend is subject to tax. Now, keep in mind, this is a very simple example. There are credits that you can get for investments and things like that. But for simplicity, we are going to just keep with our simple example. And so let's say his tax is going to be $9,259 on the dividend. So his total taxes is $21,000 plus his $9,259 for a total tax of $30,259. And you can see that this is much higher than if he was able to select a S corp. And so what we're seeing is that it does make a very big difference, the legal entity structure that you choose to operate yourself within for your business. And so when we're deciding on what type of business entity fits our business and which is going to be best for us, not only do we have to consider the liability protection factor, but also the tax impact of that legal entity. I hope that today was helpful, and I look forward to seeing you again. Until next time.